Forex trading, also known as foreign exchange trading, involves buying and selling currency pairs to profit from price fluctuations. It is the world's largest financial market, with a daily trading volume exceeding $7 trillion, making it more liquid and active than any stock exchange. It serves multiple purposes: commercial transactions between businesses, currency exchange for tourism, and speculation aimed at making profits from price changes. Why people trade Forex? There are many reasons to trade in Forex. Primarily, making money is the most frequently cited reason for why trade Forex. 1. Forex market never sleeps. It operates 24 hours a day, 5 days a week, and involves trillions of dollars worth of transactions daily. 2. Low transaction cost. Most Forex accounts trade with little or no commission, and there is no exchange or data license fees. 3. Leverage. Leverage is the mechanism by which a trader can take position much larger than the initial investment. Leverage is one more reason why you should trade in Forex. Few currency traders realize the advantage of financial leverage available to them. 4. High liquidity. The size of Forex market is enormous and liquid by nature. High liquidity means a trader can trade with any type of currency. Timing is not a constraint as well. Trading can be done as per your convenience. 5. Accessibility. Getting started as a currency trader would not cost a ton of money, especially when compared to trading stocks, option, or future market. We have online Forex brokers offering mini or micro trading accounts that let you open a trading account with a minimum account deposit of $25. For beginners, Forex trading may seem complex, but with the right approach and knowledge, you can start confidently. This guide will walk you through the basics and help you make your first trade. Step 1. Understanding the Forex market. The Forex market is enormous in size and is the largest market with millions of participants. Hundreds of thousands of individuals, like us, money exchangers, to banks, to hedge fund managers, everybody participates in the Forex market. Forex trading takes place in a decentralized market where currencies are exchanged 24/5 across global financial centers. Traders speculate on currency price movements by major trading pairs such as Euro/USD Euro-Dollar against the US dollar, GBP/USD Great Britain Pound against the US dollar, or US dollar to Japanese yen US dollar against the Japanese yen. When should you trade? It depends on the currency pair and the strategy that you have. From the map, you can see that when New York opens, the European session is only halfway through. This is represented by a large amount of money in the market or liquidity. Most major pairs are traded in the combination of the sessions, which means that a lot of opportunities for traders can emerge in that period of time. The Forex market operates in 3 major sessions: Asian session, Tokyo; European session, London; American session, New York. Understanding these sessions is crucial because market activity varies throughout the day. Tokyo trading session, 7 p.m. to 4 a.m. New York time. Tokyo is the first market to open, and many large participants use the trade momentum there to develop their strategies and as a gauge for future market dynamics. Approximately 6% of the world's FX transactions are enacted in the Tokyo trading session. London trading session, 3 a.m. to 12 p.m. New York time. London is the largest and most important trading center in the world, with about a 34% market share of the daily Forex volume. Most of the world's largest banks keep their dealing desks in London because of that market share. The large number of participants in the London FX market and the high value of the transactions makes the London session more volatile than the other 2 sessions. New York trading session, 8 a.m. to 5 p.m. New York time. The second largest trading market, New York handles approximately 16% of the world's FX transactions. The majority of the transactions in New York occurs during the US/Europe overlap, with transactions slowing as liquidity dries up and European traders exit the market. Who plays on the Forex market? 1. Governments. They use the Forex market to meet certain economic goals. 2. Central banks. They represent the financial arm of the government. They use the Forex market to adjust monetary policy. 3. Normal banks. They trade on the Forex market to find the correct amount of currencies that they need to develop their activities. 4. Other financial institutions. for example, pension funds that invest in the Forex market to obtain returns in exchange. 5. Multinational companies. They operate on the Forex market in order to do transactions between different locations where they are established. 6. Hedge funds. Organizations that are designed to speculate in the Forex market and obtain a high amount of returns for their investors in exchange of commissions. 7. Retail traders. Traders such as you and I, people who speculate on the Forex market to make a profit. Step 2. Choosing a Forex broker. This is where the concept of a broker comes into play. A person such as you and me will go to a broker. Their role is to work with other individuals as well, to aggregate all the transactions and send them to the bank, which has direct access to the Forex market. To start trading, you need to sign up with a Forex broker. When selecting a broker, consider the following. Regulation. Ensure the broker is regulated by authorities like the FCA, SISEC, or NFA. Trading platforms. Look for a broker offering MetaTrader 4, MT4, MetaTrader 5, MT5, or CTrader. Spreads and fees. Lower spreads and minimal commissions improve profitability. Leverage options. Some brokers offer leverage up to 1:500, but beginners should use it cautiously. Deposit and withdrawal methods. Ensure the broker supports your preferred payment method. Step 3. Opening a demo account. Before trading with real money, practice on a demo account. A demo account allows you to trade using virtual funds, helping you learn how to place orders, analyze charts, and develop strategies without any financial risk. Opening a demo account is the first step every beginner should take before trading with real money. It provides a simulated trading environment where you can practice using virtual funds, meaning there is no risk of losing your own capital. Through this account, you can learn how to place buy and sell orders, understand how market movements affect trades, and become familiar with the trading platform's features and tools. This practice phase helps build confidence and prepares you for the real market environment. In addition to learning the basics, a demo account allows you to test different trading strategies and refine your decision-making skills. You can analyze charts, study price trends, and monitor how various market events impact currency pairs or other assets. Since no actual money is involved, mistakes become valuable learning opportunities rather than costly errors. By practicing consistently on a demo account, you increase your chances of success when transitioning to live trading. Step 4. Learning the basics of Forex trading. Learning the basics of Forex trading is essential for anyone who wants to succeed in the market. The foundation of Forex lies in currency pairs, where one currency is bought while another is sold at the same time. For example, in the euro to US dollar pair, the euro is the base currency, while the US dollar USD is the quote currency. Understanding how these pairs work helps traders determine the value of one currency relative to another. Another important concept is the bid and ask price. The bid price represents what buyers are willing to pay for a currency, while the ask price is what sellers want in exchange. The difference between these two prices is known as the spread, which is essentially the cost of trading. Since spreads vary depending on market conditions and brokers, new traders should pay close attention to them as they directly affect profitability. Forex trading also relies on terms like pips, lots, leverage, and margin. A pip is the smallest unit of price movement in a currency pair, commonly used to measure gains or losses. Trades are carried out in lots, with one standard lot equal to 100,000 units of the base currency, though smaller lot sizes are available for beginners. Leverage enables traders to control larger positions with a small initial deposit margin, magnifying both potential profits and risks. While leverage can be a powerful tool, it requires careful management to avoid significant losses. Step 5. Analyzing the market. The very basic representation of the market at any point in time is a simple bar, and a bar is no more than prices being mapped in a graphical way. A bar always includes what we call OHLC, which stands for open, high, low, and close price. As you can see in the graph, the open price represents the first price of the period with a dash on the left, the high price represents the top of the bar, the low price represents the bottom of the bar, and the close price is represented with the dash to the right. When you assemble a number of these bars, you get a bar chart. The colors red and green help the traders to identify which bars are going up, bullish bars, and which are going down, bearish bars. The next type of Forex chart that is very popular among traders is the candle chart. In essence, it carries the same information, but represented differently. The candlestick chart is one of the most popular tools in Forex trading because it presents price data clearly and in detail. Each candlestick shows the opening, closing, high, and low prices for a given time frame, making it easier to identify trends and market sentiment. Unlike simple line charts, candlestick patterns such as doji, hammer, or engulfing can signal potential reversals or continuations, giving traders valuable insights for decision-making. Each of these candles has a body and two shadows. As in the bars, the top and bottom of the shadows represent the high and low prices. On the other side, the top and bottom of the body represent the open and close prices of the period. Finally, we have the third kind of chart called a line chart. It is the union of the close price of the periods in the chart. There are two primary methods to analyze the Forex market. One. Fundamental analysis uses charts, indicators, RSI, MACD, moving averages, and price patterns to predict price movements. This type of analysis is based on the belief that somewhere, out there in the world, there is information or knowledge that is not yet reflected in the market price. Traders that practice this kind of analysis think they can take advantage of the market by entering into the right position, whether it be buy or sell. Fundamental analysis includes reading and understanding news surrounding certain currencies, understanding the global economic climate and what's happening in the world to affect the performance of a particular currency. It also involves understanding the current situation of resources, such as oil, because certain currencies correlate with the prices and supply/demand of resources. A convenient way of doing this kind of analysis is through an economic calendar, which summarizes what is happening in the world. However, it is also advisable that you do your own research. 2. Technical analysis involves economic indicators like interest rates, GDP reports, and political events that impact currency values. This type of analysis is based purely on the belief that all available information in the world is already contained in the price. Therefore, all you need to do is analyze the charts with no need to analyze news or interest rates of the countries, etc. Traders who believe in technical analysis think that prices move in trends and that historical patterns tend to repeat. This is how they proceed to take advantage of the market by opening a position. The main technical analysis tools used by traders: trends and flats. One of the most common things in the Forex market is a trend. So let's try to understand what a trend is. Upward trend. The graph illustrates the action of a price, green line, and you can see that we can draw a blue line beneath the price. The blue line is called the support line, and it indicates an upward trend, and it means the price is bouncing upwards and it is continuing in an upward movement. You can therefore expect that the price will come back again, hit the support line and bounce off and keep moving upwards. A technical trader can take advantage of this by setting a buy position, expecting the price to continue going up. The graph illustrates the opposite example, where the price is going down, and if we draw a red line above the price, this one seems to be forced to go down. The red line is called the resistance line, and you can expect the price to continue to go down if it approaches the resistance line, bouncing off downwards. Therefore, a technical trader can take advantage of this by setting a sell position in the market. The third type of market is a flat market. In this case, we cannot draw a support or resistance line because the market is moving sideways. Number 2. Channels. We can complement a support line by drawing a channel, graph below, by copying the line and putting it above the price, green line. As you can see here, the price seems to be bouncing off downwards against the top blue. The price seems to be going through a channel or corridor. We can anticipate that if the price is going up, then it may be bouncing down again, dotted line, and when it reaches the support line, it may be a good time to set up a buy order. There is a high probability that it will bounce against the top line again, and the price level marked with the X might be a good point to close the position or set up a take profit. In the case of a downward trend, graph below, we can do the same process by copying the resistance line and putting it below the price. In this case, we would expect the price to come up and hit the resistance line again. We can then open a sell order to close our position or set up a take profit in price level marked with the X. Number 3. Triangle pattern. The triangle pattern is a very powerful but at the same time a simple formation on the Forex market. If we take a look at the following example, we can see how if we draw two lines, yellow lines, above and below the price line, the price seems to move in a triangle formation. The price movement decreases in its movement range and reaches a point where it cannot move anymore inside the triangle, which is exactly when the price shoots up, it can shoot down as well. This shooting represents an opportunity to set up a buy position and profit from the upward movement in the market. Sentiment analysis. It is more of an auxiliary which you can add to your analysis to make it more robust. Sentiment analysis implies an understanding of the general mood in the market, what traders are thinking and what their expectations are. A good starting point for that is Twitter and Facebook. You can go on Twitter and search for the currency pair you are planning to trade and see what people are saying and what they are expecting. Or you can go on Facebook, where you can find certain groups or circles talking about the Forex market. Why is this important? Well, at the end of the day, many people make transactions on the market and it matters what people think. This is especially true when ideas become viral and spread across social media networks, which can influence a particular currency pair to go up or down. What is leverage? Forex trading provides one of the highest leverage in the financial market. Leverage means having the ability to control a large amount of money using very little amount of your own money and borrowing the rest. For example, to trade a $10,000 position, traded value of security, your broker wants $100 from your account. Your leverage, which is expressed in ratios, is now 100 to 1. In short, with mere $100, you are controlling $10,000. Therefore, if during the trade $10,000 investment rises in value to $10,100, it means a rise in $100. Because you are leveraged 100:1, your actual amount invested is $100 and your gain is $100. This in turn your return to a groovy 100%. In such case, the trade goes in your favor. What if you have ended up with a -1% return, $10,000 position? -100% return using 100:1 leverage. Therefore, risk management of leverage position is very important for every trader or investor. What is margin? Margin is the amount of money your trading account or broker needs, should have as a good faith deposit to open any position with your broker. So consider the leverage example in which we are able to take position of $100,000 with an initial deposit amount of $1,000. This $1,000 deposit amount is called margin you had to give in order to initiate a trade and use leverage. Your broker, to maintain your position, uses it. The broker collects margin money from each of its client, customer, and uses this super margin deposit to be able to place trades within the interbank network. Step 6. Placing your first trade. Once you're comfortable with analysis, follow these steps to execute your first trade. 1. Choose a currency pair. Select a pair based on your research. 2. Decide trade size. Choose the number of lots to trade. 3. Set stop loss and take profit levels. Manage risk by setting predefined exit points. 4. Execute the trade. Click buy long if you expect the currency to rise or sell, short if you expect it to fall. 5. Monitor the trade, track market movements, and adjust your strategy if needed. Placing your first Forex trade is an exciting step, but it requires discipline and a clear process to manage both risk and opportunity. Start by choosing a currency pair that fits your analysis and trading plan, such as Euro to US dollar or Pound sterling to Japanese yen. Next, decide the trade size by selecting the number of lots you want to trade, keeping in mind that larger positions mean higher potential profit but also greater risk. Before entering the trade, always set stop loss and take profit levels. These predefined exit points protect your account by limiting losses and securing profits when the market moves in your favor. Once prepared, execute the trade by clicking buy long if you expect the base currency to strengthen, or sell short if you believe it will weaken. After entering, monitor the trade closely, keeping track of price action, news events, and market volatility. If conditions change, you can adjust your stop loss, take profit, or close the position early. Following these steps ensures your first trade is executed with both strategy and risk management in mind. Step 7. Managing risk. Risk is a part of trading. Every trade carries a certain level of risk. The best way to know your risk is to determine the risk-reward ratio. Risk management is crucial to long-term success in Forex trading. Follow these key tips. Never risk more than 2% of your trading capital per trade. Use stop-loss orders to limit potential losses. Avoid emotional trading. Stick to your trading plan. Banks have to face exchange risks because of their activities relating to currency trading, control management of risk on behalf of their clients and risks of their own balance sheet and operations. We can classify these risks into 4 different categories. Number 1, exchange rate risk. This relates to the appreciation or depreciation of one currency, for example, the USD, to another currency, base currency like INR. Every bank has a long or short position in a currency, depreciation in case of long position, or appreciation in case of short position, runs the risk of loss to the bank. Number 2, credit risk or default risk is associated with an investment where the borrower is not able to pay back the amount to the bank or lender. This may be because of poor financial condition of the borrower, and this kind of risk is always there with the borrower. Number 3, liquidity risk. Liquidity refers to how active buyers and sellers a market is. Liquidity risk refers to risk of refinancing. Number 4, operational risk. The operational risk is related to the operations of the bank. It is the probability of loss occurring due to internal inadequacies of a bank or a breakdown in its control, operations, or procedures. Number 5, interest rate risk. The interest rate risk is the possibility that the value of an investment, for example, of a bank, will decline as a result of an unexpected change in interest rate. Higher interest rate risk is associated with long-term bonds, as there may be many years within which an adverse interest rate fluctuation can occur. Number 6, country risk. It refers to the risk of investing or lending possibly due to economic and/or political environment in the buyer's country, which may result in an inability to pay for imports. What most professional traders have in common is the discipline to follow some of the basic Forex trading rules. Let us now see what these rules are. The rules are listed as follows. Start slow. For an amateur trader, it is always better to start slow and with less money. Do not expect or think that your first trade will be a jackpot. It is common that your first trade will not work as planned. If you lose too much money, you will be out of the game soon, and if you make too much than you anticipated money, then because of your overconfidence, you will do overtrading and lose most of what you gain. Limit your losses. You should have an exit plan before you enter any trade. You should have strict stop loss in case trade is not going in your favor. If your trade is with the trend, you should readjust your stop losses and hold on to your profit. In order to keep these nightmares, your losses, from occurring, a trader should follow strict stop loss and exit the trade in case of losing trades before they turn into disasters. Hold on to your profits. Many traders have no problem cutting losses, but they also insist on exiting trades at the first sign of profits. However, they eventually see that their small profits could turn huge if they hold onto their position for a little longer. The strategy here should be, cut your losses and hold onto your gains. Trading strategy. A good trading strategy is required. However, money management is also very important. Your trade risk should not be more than 2% of your account in each trade. Listen to the charts, technical indicators. Everything is reflected in the price and volume when it comes to technical analysis. Master the skill of understanding different indicators and use it. Conclusion. Forex trading can be a profitable venture if approached with discipline and strategy. As a beginner, take time to learn, practice on a demo account, and gradually transition to live trading. With patience and proper risk management, you can navigate the Forex market successfully. Happy trading!